Excellent. Well, it's come a long way since the 10K competition where Charlie Tillett was a competitor. You won a prize, I think, your team. Third place. They had a crazy idea for something that could project using LCDs or something, sort of like these projectors. And I think you got, what, $2,000 or?
No, $300.
$300. Okay. So anyway, that was then. This is now. Charlie has been involved in entrepreneurship. He was a Sloan MBA. He and I met outside this very room at an MIT Enterprise Forum event, and he was looking around for what he was going to do next after graduated, and I had these crazy engineers who I thought were pretty cool, and they could use some help. So we hopped in your pickup truck, as I recall, went up, met him, and the next thing you know, you're there, and you took him from there to public. And so, and since then, he's gone on and worked for a variety of things. So Charlie is very good to come in, and next week he's going to be heli-skiing. That's why he's here this week. Okay, thank you, Charlie.
Thanks, Joe. Super. Well. So tonight, what we're going to talk about, so I know that you were probably thinking about organizational plans and didn't have an extra cup of coffee to think about spreadsheets. But you're going to have to put these spreadsheets together for your business, and I'll tell you why. So we're going to talk about putting together your financial plan, your projections, and also cash flow. And then if we have enough time, I have about 50% more slides than I can cover. What time do I need to, what's our drop dead?
Hard stop at 9.
9? Okay. We will definitely be done by 9, whether we're done with the slides or not. But this presentation will be online, and so you can take a look at it. And there's also 2 companion spreadsheets. One is the financial spreadsheet that I'm going to walk you through, which is the income statement, the balance sheet, and the cash flow. Okay, and then there's also one on dividing equity, where you can plug in, I raised $250,000 on a $1 million valuation, and I raised $5 million on a $10 million valuation, and I started with X number of shares myself, and you can see how much of what percentage equity you end up with. So just like our earlier speaker were talking about dividing equity, I'll try and spend a little time talking about how you should think about that in your company. And I think our messages are very similar in thinking about how to divide that. So, as Joe mentioned, I was a class of '91 graduate. Ended up 3rd place in the 10K contest. We didn't really win much money. We had no venture capitalists calling us up, but that experience. So I would urge you guys to all participate in that, because that experience gave me credibility. When Joe had me go out and meet with these engineers, and they said, well, have you ever put together a business plan? I said, yeah, I've put together a business plan. And I had that experience of doing it, thinking about all the composite parts that go into a business plan, including the financial model, but also thinking about the business and that whole process of doing that. So whether you put together a business plan for the 100K contest that you're actually going to think you actually are going to run with, it will be a great experience for whatever you end up deciding to do. As Joe mentioned, I was CFO at NetScout Systems. I was there for about 10 years and took them public. And then I joined a bomb detection company for aviation checked baggage, and I was there for about 8 years, and they were sold to a defense company. So I've been involved in a ton of transactions. I know $125 million in today's environment doesn't sound like all that much money, but I will tell you, every financing, whether it be for $100,000 or for $5 million or for $25 million, they are all all of the negotiations are equally strenuous, okay? So whether there's a lot of zeros or not, the people who are putting in their money are negotiating just as hard to take your stock as you are to hold on to it. So we'll talk a little bit about that, especially when we talk about the equity. So I mentioned I graduated in '91. I just had my 25th reunion a couple years ago, and I was really looking forward to this experience, not just to catch up with my friends and to come back on campus, but I had had an envelope sitting in my desk for 25 years that I was dying to open, because I had a professor in one class who sent us home one day and said, write your 5 or 6 what you'd like to accomplish, the 5 or 6 things you'd like to accomplish by your 10th year reunion. Go home and write that. You don't have to hand it in. Don't spend more than a couple minutes on it. The next class, he said, do the same thing, but for your 25-year reunion. And then the third class, he said, take those 2 things. I don't want to look at them. Put them in an envelope. Put them in your desk, and pull them out later. So I pulled mine out. So I was really looking for it because 25 years, I mean, think about it. I couldn't even, and I spent a couple minutes on it. So I wasn't even sure. I kind of vaguely remembered what I'd put down, but I couldn't remember the specifics, and I couldn't remember really all of them. So now, when I was here, we used to have a lot of homework, a lot of problem sets. Is it the same? Is there still a lot of work here? Yeah, okay, so good. So that part hasn't changed. So trying to make the most use of my time, I would often read cases before I would go to bed. Does anyone read problem sets or cases before they, when they're in bed, before they go to bed? Okay, I see a few hands over here. Not too many. Some of you guys aren't making the most effective use of your time, so you got a few free minutes there. So for those of you who raise their hands, what's different the next day when you've read a case before you went to bed? Okay, more competitive because you've found that extra 5 minutes to do some homework. Anything else?
Well, if you get to sleep on it, it crystallizes things in your brain.
Exactly. So if you're sitting there, the next morning you might be having coffee, and you won't be thinking, you'll be reading the paper, not thinking about the case, but all of a sudden something will pop into your mind about that case. And I think it's because your brain is, even though you're sleeping, your brain, some part of your brain, I'm sure someone here is smart enough to figure out, do an MRI on, figure out what part of your brain is actually working at night. But, so I think that that's happening. So in my life goals, let's see, 1, 2, 3, I only put 5 down. And one of them, thank you guys for helping me meet one of my 25-year life goals, was be a mentor and angel investors for small startups. So being here tonight is part of my mentoring. And so of my 5 items that I had hoped to have, how many of them do you think I met by my 25th reunion? 3? 4? Okay, 3 or 4. So the truth, and I don't say this to brag, but I had met by the 10th year, I had done all of my 10 years, and I'd actually already hit a couple of my 25 years. And by the 25th year, I'd hit all of them except for one, and that is to fly in the cockpit of an F-16 fighter plane. And I still haven't done that. So if anyone, like, maybe the Israeli Air Force or something, someone's got a contact with someone that can help me get it, do my final goal, I'd appreciate it. But what I think is happening is I'd written these things down, and just like you're thinking about those cases while you're sleeping, I think these things were ruminating in the back of my head for this period of time. And so, so even though I wasn't conscious about what I wanted to accomplish, I was still doing it. In the words of Bill Gates, he says we overestimate what we can accomplish in a year. And think of this when we're putting together our financial plans, because this is very true. You're going to overestimate what you can get done in a year, but we underestimate what we're going to get done in 10 years. And so I really wished I'd put some more challenging goals on my sheet, because who knows, I might have made something of myself. But so tonight, do it this week, because if you don't do it this week, it'll never happen. But go home and just spend 5 minutes on this experiment. Put an envelope in your desk, and then in 2044, look me up, okay? Because I want to hear how you did on your goals. Now, I know what some of you are thinking, how am I going to contact Charlie Tillett in 2024? But think of that, it's 25 years, you'll probably say, call Charlie Tillett, and a hologram of me will show up, and we'll have a real-time discussion. Some of you are probably thinking, this guy's not going to be here in 25 years, okay? But I checked the IRS longevity tables, and I'm going to make it by 0.2 years, okay? So look me up. So why are you here? Why are you here tonight? Want to learn something? Create something, okay?
Try to be successful in this process.
Okay, try to be successful. Someone else has to chime in. Yeah.
Because if I don't have a startup of my own, I know one of my friends will at some point, and it'll be nice to help.
Okay, right. So you can learn something about startups and then be able to get into that ecosystem. So whether it's start a business, maybe it's enter the 100K contest, which would be a good thing, whether you win it or not. And so what do you need if you're going to start a business, or so what do you need if you're going to start a business? What are kind of the first three things you're going to do? What are the three things that you really need?
Idea.
An idea, great, of course.
Team. Problem.
A problem, yeah, I heard team. Cash, okay. So all of those other things are great, okay? But if you don't have the cash, it's like a room without oxygen, And so you can have a great team that's running at 100 miles an hour, and then when you run out of cash, it's like everyone's got Velcro on the bottom of their shoes, right? So you can't get anything done. So putting together your financial plan, it's how you're going to figure out how much cash you need, right? So until you have the plan, do I need to raise $1 million? Do I need to raise $5 million? Do I need to raise $25 million? And I've been involved in a lot of companies, and the answer is it depends, but without the plan, you don't know. But the other thing is, your investors are going to want to see this plan, because they're going to want you to justify why you need $5 million. Or they know you're going to need $10 million, but they want you they want to see what you can get done with $5 million, because they don't want to just put it in and have no milestones. And so without that plan, you can't tell them what you're going to get done with the money that you're raising. The other thing is, putting together the plan helps you understand your business. It helps you understand the levers of your business. Maybe if we were able to drive down the cost of goods sold, that would improve our gross margin, and we could afford to spend the money on marketing that we're going to need to get customers to come buy our product. Or maybe gross margin isn't your problem, but something else is. Or maybe it's your sales price. So maybe you say, God, we plan to sell this product for $1,000, but maybe we need to tweak the product and go after a slightly different market, because we can modify the product without adding a lot of cost, but we can get it to a $2,000 sales price. And then the question is, will someone buy that for $2,000 or $1,000 or $20, whatever it is? So going through that process helps you define what your product is and helps you evaluate whether you're going to be able to find customers to buy that product, and what your marketing dollars are to find and convince those customers to buy your product. So the second company that I was at, Reveal Imaging, we were building bomb detection equipment. The equipment was about the size of a Volkswagen Beetle. There's 482 commercial airports in the United States, and every one of these airports needed someone's equipment. But there were already two competitors, and we were the third person to the party. And so we had to develop a product quick, get it certified quickly before we could start selling it, before all these 482 airports already had someone else's product. Because once they have a product, they're not going to throw that product out and bring yours in, right? So we had to hit the deck running, and so we had a founders meeting, and I left the meeting, and the CEO left the meeting, and we both started making phone calls to people to raise money. So we started raising money from the day we were started, and if you can see, within every 6 months or so, we did another kind of fundraising. And so I was always thinking about, where's the next money coming from? What's the source of it? What's the size of it? And what are we going to have to give up to get it? Sometimes I would even be thinking about the next round of financing before we'd even close the current round of financing, because sometimes you need to strike while the iron's hot. So the best time to raise certain types of financing is right after you've completed, a B round of financing. So all I can say is that, I could spend an hour talking about this slide and the various forms of fundraising, but the point I'm trying to make is that with the financial model, I was able to determine what our cash needs were, and also I had a document that I could then show to investors or lenders to convince them why they should put the money into the company. So how this presentation really got started is kind of the kernel for this was this was back before everyone had their own laptop. We had computer labs here, and I was sitting at one row of tables, and there was an engineering team on the other side of the table, and the other team is going, now, what's that balance sheet thing that we need for the 100? Everyone was working for the 10K contest. Now, what's that balance sheet thing that we need to put together? So for those of you who are in business school, this is going to be a little bit simplistic. What we're trying to do is level the field here and recognize that not everyone's got a financial background. So bear with me if it's a little bit simplistic. But what we're trying to do here is we're trying to help you create your income statement, because the income statement is what drives everything. It drives the balance sheet, it drives the cash flow, and it's what helps you, figure out your business. So it starts with revenue at the top line, and that would be, so in this case, $50 million in revenue, and that would be after any discount. So if a customer buys $1 million worth of product and they get a 10% discount, that's $900,000 worth of revenue. So you don't bother to show sales less discounts. Don't make it any more complicated than it is. The next line is your cost of goods sold. That's both the variable cost that go into making your product, the material, but it's also the labor that it takes to put that product together. And also, if you provide free support, say for a year's worth of free support or a year's worth of warranty, that is also a cost of goods sold. So you've got to incorporate, when the customer sends you $1,000 for something, everything that they get for that $1,000 has to be treated as a cost of goods sold. So it's a telephone support, or it's a site visit, or if they send equipment back and it has to get fixed, that goes into your cost of goods sold. You subtract those two and you get your gross margin. And I like to say a happy bottom line starts at the gross margin line. I've been at companies that have an 80% gross margin and companies that have a 50% gross margin. Okay, the data communication was 80%, the bomb detection equipment was 50%. It's a lot harder to make money at a 50% gross margin than it is at an 80% gross margin. So pay a lot of attention to this number here, because that really defines what you can do kind of below that gross margin line. And then you have your departmental expenses: sales and marketing, research and development, general and administrative. So research and development would be all your engineering staff. General and administrative would be your top manager, your CEO would be in there, your CFO, your HR department, your accounting department, and if you had a facilities department, they'd probably be in there as well. So you add those up, your total departmental expenses, subtract the two, and you get your operating profit, also known as earnings before interest, taxes, depreciation, and amortization. So that's the document that we're trying to help each of you produce, okay? Feel free to ask any questions as we go along. I'm happy to take them as we go. So what I would say is, if you think about, we'll come back to, I'll show you some business models, and when people ask you about your business model, they're not thinking about year one or year two. They're really thinking about what's this business look like, and what's it going to look like once you reach critical mass. So let's say you're doing prototyping and your cost of goods are very high because you don't have any economies of scale. That's going to look like something, but really when your business gets up to scale, what's it going to look like? What's your gross margin going to be, and what are your expenses going to be? And so that's how people think about the business model. So here's what we're trying to get to. We're trying to get to a 4 or possibly 5-year income statement showing, in this case, I'm showing support revenue. So for example, if you sell a hardware product and you charge people 15 or 20% a year on an annual basis to get updates for their software, that would be support revenue. And investors like that because it's recurring revenue. So you sell them the $1,000 software once, but you get the $200 software support fee every year. Now, of course, some people drop off, but it's kind of free money because you've got to keep coming up with new products anyway, or else you're yesterday's news. So what investors will look at when you show them something like this, and I see a lot of business plans, and here's what I look at. The first thing I do is I take a look at the top line. How big is this company going to be? What's their vision for what this company can be? In this case, it's growing to $66 million in revenue. The next thing I look at is their business model in year 4. What type of business is this? Is it one with good gross margins or bad gross margins? Is it one that spends a lot of money on marketing and sales or not? Where's engineering come in? And the final one is, what do they think their profit's going to be out in year 4 or year 5? The next thing I look at is what's the individual year's profitability, because that gives me a pretty good ballpark about how much money this company is going to raise. In this case, $4 million in year 1, they're going to lose. $2 million in year 2, so that's roughly $6 million. You probably lost a little bit of money in Q1 and Q2 of year 3, possibly. So this says to me this company is looking like they need to raise $7 or $8 million. Let's round up to $10 million. Does this, if they can do what they say they're going to do, which is get to $66 million in sales on a $10 million investment, does that make sense or not? Does that look like a good investment or not? I would tell you it looks like a fantastic investment. Whereas if this company needed $30 million to get here, you really need to see what's going to happen out here in years 5, 6, and 7 to determine whether that's going to be a good idea or not. Or if it's only going to grow, so if it's only going to grow to 30 million, so if it's going to take a lot more money and get to 60 million, or if it's going to take the same amount of money but only grow to 30 or 40 million. Okay, that might not be as attractive an investment. So here's what this spreadsheet,
So the question is, you mentioned the number of what amount of investment you expect to get, but there is no in these profit losses.
there's no,
So there is no request from the investor. How much money do you ask?
well, when you put together so the question is there's nothing in here about how much money you're asking for. But the numbers will tell you how much money to ask for. So when you present this spreadsheet to an investor and they say to you, well, how much are you looking to raise? You can then say, well, we're looking to raise $5 million. That will get us through 15 months and we'll have a working prototype at that time and have our first customer sales, right? Or whatever you can get done in whatever period of time. And then we're going to need another $5 million to to market this product and roll it out, right? So so you have the numbers here, and then you can, and we'll show you the cash flow in a second, but you get to determine do you like that story or not? I mean, I would tell you, raising $5 million and only having enough money for 15 months, that means you're going to start fundraising almost the day you close your round of financing, and I'd like to have a little bit longer runway. So maybe you want to raise $6 or $7 million there. So you get to decide how much money you're looking for. The investors kind of get to decide whether you get it or not, right? But that's,
Another short question. So why don't you show the 2 break-even points over here? So when you
So the question is, why don't I show the break-even point? Stay tuned. Okay. So what this spreadsheet is going to be on the website, this exact spreadsheet that you can take and play around with. It's color-coded. So anything that's in blue is data that's coming from another spreadsheet. Anything that's red is data that's going to a different spreadsheet. Anything that's, anything that magenta is going to, anything that's in red is something that's been input, fat-fingered in, or possibly with a, or fat-fingered in, and then the black is a calculation. So for example, if you put in, I'll show you some examples of formulas that you can put in and why you would want to do that. So notice on our 4-year spreadsheet, there's no data to be put in. This is all from other spreadsheets, okay? So what you're going to need to do is come up with a quarterly spreadsheet. I'd say don't go monthly because you're going to be entering a lot of data by hand. And a 4-year spreadsheet by months is 48 columns, and you will screw it up, okay? You'll put in something wrong, and there's so much information you won't catch it. So 16 columns, so this spreadsheet goes out here to Q4, year 4. But notice, everything from here also comes from another spreadsheet. So let's look at those next spreadsheets. These are all in one worksheet, all in one spreadsheet, but different pages within that, right? So here's where we start. We start at the revenue page, right, or the sales page. Now in this case, I'm assuming it's some kind of hardware product, but maybe you've got a software product, or maybe you're selling an app, right? Maybe you're selling something over the web. You know, it doesn't really matter to me whether you're selling 20 units at $10,000 or whether you're selling 20,000 units at $10. You can just plug these numbers in, you know, and get to the same place. So here we've put in our unit sales out here for the first 16 quarters, and we have our sales price being input. But notice, as we introduce our second model, we've reduced the price of our first model because it's now going to be less valuable to the customer base than our first model because there's now something newer, right? You may decide that's not necessary, but that's the example that we used. We have total product revenue, that's magenta, that goes to our quarterly spreadsheet. I've calculated, I won't get into the calculation on support revenue other than to say all I'm doing is I keep adding to the installed base and then haircut that by the people who don't buy support. So I'm assuming that only 75% of your people, of your customers, continue to buy support. So you lose 25% after year 1, you lose another 25% of those after year 2, but of course you're continuing to add new sales. And it's kind of a waterfall model. It's an up waterfall showing you know, what's happening to your installed base, and then what's happening to your support base, and then how much revenue you're getting from that. So the next one is your cost of goods sold. So here we've got variable costs. So the reason that I left this segment up here on the page, there's nothing that I'm doing up here, but what I wanted to do is as I'm making changes down here, I want to see what's going on up here. So for example, once we get to a volume of 500 units, maybe we get a discount in price because we have economies of scale. So that's why I just include this to make it easier for me as I'm filling out this bottom part by hand. So here we have our variable cost by unit. And again, everything, it's just taking the same sales numbers that we had up here, multiplying it by the cost per unit, and coming up with the variable cost. And then we have salaries and benefits from our manufacturing department and our support department and a facilities cost, and that gives us our total cost of goods sold. Does that make sense? Okay. Yeah, question over here?
Next, I see how you could sort of guesstimate everything, but I don't see how you justify your unit sales numbers, right? So you say in quarter 2 you're going to sell 20, and by quarter 4 of year 2 you're going to sell 500. Where do those come from?
Yeah, so the question is, how do you back this up, right? How do I say I'm going to sell X number, okay? Let's get to the sales and marketing page. So now we've built a model that says how big we want this company to get. Then we have to say, how are we going to grow? How are we going to generate those sales? So, your biggest expense is going to be your staffing cost. And so, so this is our cost of goods. We'll look at departmental expenses after we look at staffing, right? So your biggest expense is going to be staffing. And so I've got two companion spreadsheets. One is the actual number of people that get plugged in, right? So you just plug in the head counts by staff position, and I would urge you to keep that as compressed as possible rather than as expanded as possible, because you're going to be filling in these numbers, you're going to be adjusting these numbers a lot as you put this together. So you'd have engineering, marketing, you'd have sales, and you'd have general and administrative. So this is kind of a long spreadsheet. I'm only showing two departments. The spreadsheet that goes with this is the salary expenses. So here you plug in your annual salary for these positions, and then you multiply it by 15% to cover your benefits and your payroll taxes on them. You divide that by 4, and that gives you your quarterly expense by position. Of course, this is multiplied by the number of people in that position. So we only have one chief technical officer. You take his or her salary, multiply it by 115%, divide it by 4, and that's the quarterly cost for that position. So then we get to our departmental expenses, and so the first one we bring is our staffing expenses, and then here's an example of where you might use a formula. So I know that engineers like to buy a lot of stuff. I've worked in a lot of tech companies with a lot of engineers, and I don't know how they spend this much money on stuff, whether it be oscilloscopes or cables or software, but they like to buy it, and they all come into my office and say, we really need this or we're not going to meet our product delivery deadline. So what I use is, my rule of thumb is $2,000 per engineer per month, and it works out pretty good. So what I've done here is the formula. Now, if you think that's too much, you plug in 1,000 here. If you think it's too much, you plug in 500 if it's not enough. And what this does is this takes our engineering headcount. These should actually be in black, so that's a misprint on my part. So this just takes the headcount, multiplies it by the per person per month times 3 months, because we're converting to quarterly. And so this row, you don't need any input other than putting in that $2,000. And then the miscellaneous is just something that you just fat finger in, because there's going to be other stuff that you need. So same with your marketing and your sales department. So as you get to sales, so here we get to your question. So let's say, so here's how we need to think about this. We're growing to 50 million in sales. And so first off is, how are you going to sell this? Are you going to sell this through a channel, in which case you need probably more marketing support than direct sales force? Is this going to be through a direct sales force? And that becomes the question of, what's the product cost? Because if you're selling a $1,000 product, as you'll hear in other classes, in this session, you can't support a direct sales force selling something for $1,000 or even $5,000. It's got to be a pretty big ticket item to be worth the expense of sending salespeople out on the road and paying them, the $250,000 a year that they expect to make, right? So that's question number one, is how are we going to sell this? So let's assume in this case we say it's a high ticket item, because even though it's $2,000, we expect our customers to buy 10 or 20 of these. So the average sale, even though the unit price is small, $2,000, or I think, I forget what we had. Oh no, we had the unit price was $10,000 here. So we think the average customer is going to buy 3 or 4 of these. So the average sale is going to be $40,000 or $50,000. With that, you can support a direct sales force. So then the question becomes, how many salespeople, what do I think a salesperson can deliver in sales in a year, right? So that will tell you how many salespeople I need. So let's say it's $3 million per person, then I need 20 salespeople, and then I can plug in what my salespeople are going to cost, and then I can look at my 4-year plan and say, can I support the marketing and sales that I need to generate that 60 million in sales? And so if you say to an investor, we're selling through a direct sales force, we expect the average sales, average full-time salesperson to bring in between $2 and $3 million a year in sales, and they know something about the industry, and you know something about the industry, they'll go, okay, that seems credible. Then the question is, are there enough customers to sell $60 million worth of product? But that's a different discussion, right? Is there a market is one discussion. How are we going to go to that market is really what we're trying. This discussion, this document will not prove that there's a $60 million market for your product. What it can prove, though, is that if there's a market and it can be sold via a direct sales channel, and a salesperson makes $250,000 a year, salary and commission, then at the gross margins that we have, this business model holds up. Does that make sense? Okay. So here's the other departments, and again, another formula. Here you could put in a commission for your salespeople. Let me urge you to, so thinking about the first question, is there a market there, right? The approach that you can't use is to say that the market for this product is $1 billion, right? Whatever. It's easy to say there's a $1 billion market for something, or a $500 million market. And we're only going to capture we're only projecting that we're going to capture 5% of that market. I don't want to say you'll get laughed out of someone's venture capitalist office, but you will not add any credibility to your argument, because no one's entitled to 5% of any market. No one's entitled to 1% of any market. It helps validate that, yes, there is a market. It validates your 66 million by saying, hey, it's $1 billion market, and we think we're going to capture 6% of that market. But how we're going to do it is not because we're entitled to it. How we're going to do it is by a bottoms-up analysis of how many salespeople we have. Or let's say you're selling apps, right? So you're buying keywords, what's your click-through, what's your purchase through that click-through, build a whole waterfall model that says we're going to start with X number of page views, and of those page views, some percentage are going to click through to our website, and of the people that click through to our website, some percentage are going to actually buy our stuff, or going to fill up a cart, and then of the people who fill up a cart, some percentage of those are actually going to put in a credit card or PayPal information and buy the stuff. And that's something that you can track every single day, right? And it's also something that someone who knows that space is going to say, well, you'll never get 10% of the people who see your ad to click through. It just doesn't work that way. So you need to find someone who really knows online marketing and what the metrics are and what the costs of gathering an eyeball are to create that funnel, sales funnel, that eventually gets you to someone clicking buy.
Question on the same what you said, estimating the market potential.
Yes.
Is there a thumb rule to estimate the market forces when you get into the market? Because you're going to be eating from someone's market share and they're going to do something about it. So, based on your experience, do you see that when I estimate, okay, I'm going to go to 60 million if there's a free market down there and I have full demand of my product, but I'm going to face some market forces which are going to dip it down to some percentage?
Yeah, so your question is, okay, so even if there's a big market and 60 million is only 6% of that market, well, I'm taking that from someone. Well, first off, you'd like to think you're going into a large and growing market, right? So it's $1 billion market, but hopefully it's growing 20% a year. So you don't necessarily have to steal from someone, but they're going to look at it because they're viewing that 20% growth as 100% belonging to them and 0% belonging to you. So you're still going to have to fight, tooth and nail to get it. This goes we're a little far afield from my presentation. What I would say is a lot of people make the mistake of saying, hey, let's do a competitive analysis, and the existing products are all $1,000, and we have a product that that's $500, and so therefore we're saving the customer $500. We think we should keep $400 of the $500 we're going to save our customer. And the customer is saying, I've got a solution that works with a vendor that I know, and there's a lot of corporate inertia to just keep doing what's working. And for $100, I'm not interested. So you're going to have to be so compelling on your value proposition. You're going to have to come in and say, listen, we can save $500, but we're going to keep $100 of that. So what you really go to the customer and say, we can offer you $400 savings on this $1,000 problem that you have. And at that point, the CFO will be interested in talking to you, okay? Because now it's worth taking the risk of maybe working with a new company. So that brings us back to our 4-year profit and loss, our quarterly profit and loss, and then that flows right into your 4-year statement. So how do you guys think about putting this together? What I do, and I'm working with another company now. So I'm working with companies all the time, and so someone once said to me, how come all startup companies' revenue growth, how come they all look like that? Can anyone tell me why they all look like that? No one? Okay, we got one.
People are overly optimistic.
Oh, okay, so maybe so people are optimistic. Okay, well, I'll tell you why. Because companies that have growth charts that look like that don't get funded, okay? And even the ones that look like this don't get funded. So you've got to look like that to get funded, because growing companies are what create excitement. Those are what create value. So so everyone's got to have a spreadsheet that kind of looks like this. So when you're putting together your plan, you're going to keep flipping between your 4-year, 5-year plan and your detailed plan. And you're going to be looking at this and saying, did we grow big enough or did we grow too big? And then go back to your revenue page. So I would say, as you modify pages in your spreadsheet, start here and work your way down. So first build the top line that you like, because now you need to staff to support that top line. Whereas if you build your staffing plan and then you don't have the revenue to support it, well, then you've now got to go in and just change something that you've already spent a lot of time building. So start with your top line and go into the revenue plan and say, how are we going to get there? How many products do we have to sell? Does that get us to our volume pricing so that our cost of goods are good? And then you can walk through your departmental expenses. So I think I got ahead of myself. Look at your top line, and then look out here and say, do I like this business? Is this a business that is attractive? Is this realistic? Do I think 24% is realistic? I will tell you the biggest problem I see when people says, hey, Charlie, would you mind looking at our plan? Is someone comes in with a plan, and this is $200 million instead of 50 to 100 million. Because why? Well, because we're going after a really big problem, right? And it's a huge market. And if we don't show this thing going to the moon, no one's going to be interested. But not a lot of companies grow to 200 million in 4 years. And so at first blush, I go, okay, that's a little optimistic. And then the other thing that they show is, like a 60% operating profit. Because what they've done is they've grown the top line, and then they've left all of this growing at a very snail's pace. When in reality, as your company grows, everything grows with it. And so, I don't know what the right number here is, but it's not 60%, and I'll show you some real world companies in a second. Okay, so then you can put your head around year one, and you can think about the people you would hire. Let's say we're starting today. What are the 10 people I'm going to hire? The 15 people I'm going to hire? What do I think they're going to have to get paid? So this is very tangible. You should be able to figure out these expenses pretty easy. And then, you know, it's a little bit of a leap to say, okay, let's say we doubled that as we get into year two, or, you know, or we shift it around a little bit, right? We're all engineers in year one, but now we're going to start bringing in some other departments, right? So, so then you do that, and then what you're really trying to do is kind of blend these together so that it doesn't go like, you know, it doesn't jump all over the place, so that it kind of tells it's a consistent story over those periods of time. Knowing your cash position is critical. In the spreadsheet, I have both the balance sheet and a cash flow statement. I will tell you though, even for the MBA students, putting together a cash flow statement is the hardest thing to do in accounting. And it's fraught with risk because the balance sheet has to balance. That's why they call it the balance sheet. But when you're putting together a cash flow projection, the way you get it to balance is the cash becomes the plug number to make it balance. And so any error that you make in your balance sheet by pulling it over from the income statement, or in how you're recognizing things from the income statement, any error you make, or if you forget to put a plus sign instead of a negative sign, shows up in cash. And so you can, if you're not super careful, it's easy to make a mistake. So I have something that's a little bit simpler. It's not great, but it's a pretty good approximation. And so what I say is, let's take a look at, and this gets back to the question here of, well, you haven't shown us how much money you raised. And so what I did here was, I've left a column for you to plug in how much money you're going to raise. So you plug it in as though you raised it, even though you haven't raised it yet, but you know, you've got to make some assumptions, right? This whole thing is an assumption. You pull in your revenue from your P&L quarterly, but you delay it by 1 quarter. Why? Because customers don't pay you money the day that you ship stuff, unless you're selling with a credit card, right? You send them an invoice, they sit on your invoice. You're a small company, they don't have to pay you right away. Eventually you'll get your money, but count on 90 days to get that. However, your vendors want their money right away, and your employees want their money right away. So here from the P&L, you're going to pay for your stuff, you're going to pay your departmental expenses right away, and you're also, any capital expense like workstations and stuff like that, you're going to have to pay for that right away. And that tells you your change in cash is you raised $5 million, so your total change in cash in Q1 was plus $4 million. You end with $4 million, that becomes your starting balance, and then you go through the same exercise. And when this number becomes 0, plug in some more money. Never show anyone a projection where you have negative money in your checking account, because that's mathematically impossible. Okay, I mean, yeah, you can overdraw it $10, but you really can't overdraw your checking account $1 million. It just doesn't happen. So always assume, you just say, here's what we're going to do. In Q1, we're going to raise $5 million, and in Q4, we're going to raise another $12 million, and then that's going to take us through completion, right? And if you don't like those numbers, then figure something out. Then you got to rework. You got to rework some of the numbers if you don't like what's showing up, because this is what's happening. This is what's going to happen in your company, okay? All I will say is CFOs, we like to think about percentages. We like to think about that year 4 and what's happening out there, and I'll show you why. So let's look at some businesses. Retail, not very good gross margins, no R&D, you know, a moderate amount of SG&A, and not great operating profit. And as we can see, revenue per employee, well, it's all over the place. Employees, let's look at revenue per employee. It's actually pretty consistent in the 160 to 180K range. Some of these numbers are a little bit old, you know, not from the last year or two, but I think they're still pretty reflective. Let's look at fast food. Again, terrible gross margins, although Starbucks, it kind of tells the story of Starbucks, doesn't it? It's a lot more profitable to sell $5 lattes than you know, dollar menu Big Macs, right? Okay, but you've got you got to pay for those comfy seats, and you probably have a lot less volume in the store than when you're cranking out through the drive-in window at McDonald's. And look at the revenue per employee, $65,000 per employee. Let's look at some tech companies. Now they're starting to get interesting. Good gross margins in the software business, not quite as good in the hardware business. Medical devices is more like a hardware business. What's interesting is Dell is not really, I don't call it a tech company, it's really a supply chain company. They're spending very little on R&D, and this was before the EMC acquisition, so maybe it looks a little bit different now. Revenue per employee, though, this is what you want your companies to look at, $500,000 to $600,000 in revenue per employee. Okay, and on your spreadsheet, I would urge you to, in fact, in there is a calculation of annualized revenue per employee. And if that revenue per employee gets over, well, let me just show you these. This is some software companies. Again, Microsoft, you'd think gross margin would be 95%, right? What does it cost them to have you download something off the web? But they've got support, and they've got to maintain their data centers. And so gross margins of 80%, operating profit of 44%, revenue per employee 645. Let's look at Google. Google, when I first started doing this, Google had half the number of employees, and the revenue per, Google had revenue per employee of about $1 million, and I said, this can't continue. And so I updated the figures about 4 years later, and they doubled the number of employees, and the revenue per employee had gone from about 1 million to 1.1 million. So it is possible it is possible, but if you're projecting that you're going to have $1 million in revenue per employee, you're in some pretty good company there, okay? Especially if you say you can do it in 4 years, and not a lot of people are going to believe you. So track that number. You don't have to show it to anyone. That's just for internal consumption. Track that number, and if it gets too high, add more employees. So I guess the takeaway from this is a lot of people go, well, should we do a best case scenario, worst case scenario, most likely? No, there's spreadsheet overload. Go in with one spreadsheet and say, this is our plan. This is what we think we can do. If you think it's too aggressive, maybe you need to dial it back. Or if you think it's too conservative, then maybe you can add some heft to it. But don't bother to say, well, here's what we're convinced we can do, but here's our stretch plan. No one wants to see that. Don't make it too complicated. Don't allocate expenses from your general and administrative department, even your facilities. Just treat that as a general and administrative expense. Don't depreciate it. Especially just show your pre-tax profit. I've seen spreadsheets where they go, okay, we lost $1 million in this year, and then next year we lost $500,000, and then the next year we made $1 million, but we had $1 million tax loss carry forward, and eventually we started making money on an after-tax basis. Look, making money on an after-tax basis is a great thing because that means you've chewed up all your net operating losses from prior periods. So just don't complicate your spreadsheet with taxes. No one cares. So I'm just going to give you some rule of thumb here. As our first speaker said, I'm trying to make your plan look interesting for investors or for 100K judges in that case. Okay, you might be able to come up with. You might have a business plan that's going to generate $2 million in revenue. You and a buddy from MIT are starting this business. You're going to have low expenses. Maybe you make $500,000 a year from this business, and and you don't have to work too hard, and it's a great business. But it's going to generate $2 million a year in revenue and never get bigger than that. No one's going to invest in that business. That doesn't mean it's not a great business. It could be a fantastic business. So recognize that investors have a screen of companies that they need to invest in. And so I'm trying to help you become attractive for them. If your plan doesn't fit into this, don't think that it's a bad plan. The question over here.
I'm sorry if I missed something, but could we go back a slide? I wanted to ask you about depreciation or amortization.
Yeah.
Capital expenditure. So should we just recognize it as cash outflow
Yeah, so the question is why do this? So depreciation, let's say you buy a $100,000 piece of equipment. Let's say you buy, maybe it's not $100,000, but let's say you buy a $10,000 piece of equipment and it has a 2-year life. Then what you should do is treat $5,000 of the expense this year and $5,000 next year. But the reality is you're out the $10,000, and that's, let accountants like me worry about stuff like that. The investor is just going to say, unless you're buying millions of dollars of capital equipment, okay, you don't complicate it by depreciating it. Everything should be on a cash basis, right? And just if someone asks, oh yeah, this is on a cash basis, so they'll know, well actually your numbers are actually going to look a little bit better than this, but all everyone cares about in the beginning is cash, right? How much cash you're going to need and why. Think about your product, how much customers will pay. Think about your distribution strategies I mentioned earlier. That's going to make all the difference in both your cost of goods sold, your sales and marketing expenses. Your R&D expenses, as we looked at most of those tech companies, ends up about 10 to 20%, maybe 25%, especially out in years 4 or 5. So if yours is higher than that, you're going to get some questions on it. That doesn't mean it's wrong. It just means you're going to get some questions on it. If it's lower than 10 or if it's lower than 5%, people are going to say, are you really putting enough money into your future products? But listen, we're all from MIT, so you're probably going to spend more on R&D than less on R&D, right? G&A should end up about 5 to 15% and build in an operating profit. Now, the hard part is actually going to be getting it down to 20%. So, okay, so fine, you want to put in an operating profit of 30%, I can live with that. But if it gets over 40%, you don't have enough expenses baked in there. And so I would add more staffing. Staffing are going to be, I talked about growing, how big you should grow your company. Your average employee expense is going to be over 100 grand these days. I mean, what's a software engineer cost now? What's an undergrad MIT graduate make on average? Someone's got to know that number. Come on, aren't you going? Anyone go to MIT? So what is it? Someone make a guess. 70K. 70K. It's actually 80K. And my undergrad alma, BU, the average salary is 60K. Okay, so you're going to be hiring all college grads for the most part. I mean, there's no even your admin staff of the few that there are going to be college grads, and so so it's going to be your average salary is going to, and you're going to hire a lot of algorithm engineers, and those guys make a wicked amount of money. Okay, so your average salary expense is going to be $100,000 or more. You're going to add about 20% to benefits to cover your payroll taxes and health care. And so your salaries are going to be 66% of your expenses. So as you figure out what you need to modulate your expenses, get them higher or lower, the first place to look is your salaries. Plug those salary dollars in, and then once you've done that, plug those headcount numbers in, and once you've done that, then plug in your departmental expenses, okay? That's by my experience. And I have a friend who has started at a new company. I hadn't talked to him in a couple of years. He's a CFO. I said, hey, Dave, can you do me a favor? Pull out your payroll report, multiply it by 26 so we can get an annualized payroll, and divide that by your total expenses for the year. It was between 60 and 70%. So it's a pretty good rule of thumb. And so that if people says to me, hey, people go, well, I won't tell you how much our company revenue is, but we have 100 employees and we're break even. I go, let's see, 100,000 employees, they're probably paying 150 each. That's $15 million worth of expenses. They're break even. So, you know, they're probably doing about $20 million in sales, right? Because if they just give me their headcount number and whether they're break even or profitable, I can give you within 10 or 20% of what their revenue is.
If it most of the expenses here, of course, we cannot do this.
Well, because I know what their expense, I know what their payroll expense is going to be, and if I know their payroll expense, add 50%, and that's going to be their total expenses, excluding variable costs of goods sold. Okay. How much to pay yourself? Okay, so if you're an undergrad from MIT and the average salary out of MIT is 80 grand, pay yourself 80 grand. Maybe pay yourself 90 grand, but you know, if you should really, you're not used to making much money anyway, and so you're used to making no money, okay? And the less money that you spend means the less money that you raise. So I would argue that if you pay yourself 70 grand instead of 80 grand, you might need to raise a little less money, and you might have to give up a little less dilution, or that money that you raise from your friends and family will last another month or two, and therefore, when you actually do your venture raise, maybe you have a better valuation. So you don't have to pay, you know, they don't want you to starve, right? They don't want you to be thinking about how you're going to, how you're going to pay your rent. Okay, but they still want you to be hungry, right? So don't say, oh, I'm the CFO, I'm the CEO of the company, and I read somewhere CEOs make 150 grand, so even though I'm a newly graduate, I'm gonna pay myself 150 grand. Does that make sense? And if you're a graduate student, you know, kind of the same thing. You know, so maybe something a little less than market, but whatever people are making in your discipline when they graduate, okay? The other thing is they don't want you to spend your own money, right? That's what investors are putting in money for, okay? But they want you to spend their money like it was your own. And you should, because the better you take care of your investors, the less money you're going to need to raise, and the better valuation on the next round. I've got a bunch of slides I'm trying to get to before I turn into a pumpkin. So I guess this book that was recommended was called, what was it called? Slicing the Pie. Okay, so I came up with Sharing the Pie. I've been using this presentation for, I don't know, a bunch of years, so I should have trademarked that one. But so what are venture capitalists looking for? Okay, they want to get a significant amount of money invested, and that means not $1 million. I mean, these guys are raising hundreds of millions of dollars of funds. I mean, they're raising $500 million funds now, $800 million funds. So they've got to get a lot of money to work, 5 million, 10 million, at least, and with the actually the opportunity to put more money in, right? And they want to own a significant amount of ownership. So even if they put in 5 million, they don't want to put in 5 million and only own 5% of your company. I mean, yeah, if you're Uber doing a round Z, right? Okay, that's one thing. But if you're a startup raising rounds A or B, they want to have a significant amount of ownership. So there is a formula. Yeah, I think is there a panel on fundraising? Okay, so there's a panel on fundraising, and I guarantee you someone's going to say, well, how do I value my company? And someone on the panel is going to say, oh, well, I mean, there really is no formula. Well, there is a formula. Now, the formula doesn't give you the answer, but if you know the formula, then you can start to formulate how you are going to think about this. So the formula is this. The venture capital percentage is equal to the money that's being invested divided by the pre-money valuation plus the money that's invested. So you heard me talk earlier about the spreadsheet that I'm going to show you. I said you raised $1 million on a $5 million pre-money. Well, what does that mean? Okay, so here's our example. $4 million investment on a $6 million pre-money is 4 divided by 6 plus 4 is 4 divided by 10 is 40%. So what the investors will do is they'll say, we agree to 4 on a 6, and at the end of the day, you have to issue them enough shares to where their shares are equal to 40% of the total shares outstanding, okay? And we'll walk through that example real quick. So here's an example where you have 2 rounds, an A round and a B round. So the A round was $5 million on a 5 pre, so they got 50%. The B round was 10 million on a 15 pre, which would be 10 divided by 25. That's 40%. But note what happens is the A round gets diluted by the same 40% as everyone else. And so the 50% that's owned by the people in the A round is now down to 30%. Does that make sense? Okay? So let's assume that it's the same investor who did the A and B round. They put in 5 million plus 10 million, they put in 15 million, they own 40% plus their 50% that got diluted to 30%, so they own 70% of the company. Now they're looking to get 4 times their money back in 5 years. That's kind of the, that's what we'd like to get. It sounds onerous. It sounds like it's a crazy return. I did the math one day. It's like a 35% IRR. It's not actually a crazy return. I mean, because there's a lot of deals where you could get a 20% IRR. I mean, don't get me wrong. It's a great return, but it's not crazy. So in order to get that 4 times return, they need to get $75 million back, right? 15 times 4 plus their original 15 back, right? They don't get to count that twice. And so in order for them to get $75 million, your company's got to be worth $108 million at exit. And if it's worth $108 million at exit, in my sense is you've got to get those revenues to at least $50 million for your company to be worth $108 million. So that's why I always say, get your company to 50 million, between 50 and 100 million. You do not need to get this over 100 million for this to be a win for your investors, okay? So here's the spreadsheet. So what we've done is we've taken each of these columns is an event. So the company gets founded and the founders start with 4 million shares split between them. The detailed spreadsheet has individual names and all of that. Then the early investors come in, early employees come in, and early employees, and I'll give you some percentages about what I think employees should get, but early employees who are coming in probably before you've got funded and while you may be going out of business, they're taking on more risk than the employees who come in after you've just raised a $5 million round of funding. And they should get compensated for that in terms of shares. So usually, 2, 3, 4, 5 times more shares for employees at this round than employees who come in late after the funding's in. So here you bring in your early employees, and notice our founders have already gotten diluted down to 88%. You then raise 500 on 4.5 million, so those angel investors get a 10% ownership, and so everyone gets diluted by 10%, so our 88% gets diluted down to 80%. We then have a VC round, 5 million at 5, that's the 50%, but one thing that happens in this A round is the investors say, we want to see an option pool for future employees. We do not want to be diluted just because you hire the employee, just because you're going to use our money to hire a bunch of employees. We don't want to get diluted when you give those employees stock options, and they will force you to put in an option pool, and you probably aren't going to get away with 12.2%. It's probably going to have to be 15%. It might be 20%, and it could be 25%, depending on how early stage you are and how good you are at negotiating. But that's a painful bite because you're giving up 50% here, you're also giving up 12% here, and look at this, the founders have gone from 80% down to 30%. Then we have our second round of financing, comes in at 10 on 15 for 40% dilution. Notice what happens here. Just the math makes their percentage go down to 30%, and the founders now go to 18%, okay? All I would say is the most important thing on here is the work yet to be completed is greater than the work that has been completed. So don't be rewarding people for what they've done in the past. Give people options for what they're going to do in the future. And everyone should vest. And so in our example here, where the professor and Joe go into business, and a month later Joe says, I'm going to Tahiti. First off, nothing should vest for 1 year, and then after 1 year you get 25%, and then you get maybe every quarter you get another 6.25%, so after 4 years you're 100% vested. So if Joe quits in the first year and goes to Tahiti, well, his stock, he doesn't get it. He doesn't get to keep it. And even if he quits after 13 months, well, he only gets 25% of what he keeps. So even though you're all founders and everyone says, yeah, we're rah-rah, we're in on this, make sure everyone should vest as a protection against someone departing, and it can really completely poison the well if there's 4 founders and one just quits and goes and takes a $150,000 algorithm engineer job, and now you've got to go hire another algorithm engineer, and that person still owns 25%, the same amount of equity that you have. Yeah?
Does that clock start again every time you take a new round of funding?
No. So it starts, so that 4 years would start when, you and I are starting a company today, we put our team together. Believe me, people don't put their stock option paperwork together right away. We have a company.
Is VC going to ask you to revest?
No.
Every time you do a round?
Well,
Everything's negotiable in a VC agreement. So depending if you've got key employees that essentially like the technology cannot be built without this guy, yeah, they might have some of your shares vest. They might like read their percentage.
yes.
But they'll extend the lifetime. So everything's negotiable.
Yeah, and what you should say if someone says that is, you know what, why don't you give me more shares so that even though my old shares are going to be fully vested 18 months from now, I have an incentive to stick around, okay? So if you're that important to the company, okay, that they want to keep you around, don't let them make you revest your shares. So in terms of your planning, think about these percentages. Basically a VP level, or C level, really any C level is in the 1 to 2.5% after all the rounds of financing. Maybe not anything past a B round, but after that stage, that's what they should get. A CEO, if you brought in an external CEO, would be 5%. Individual contributors, like just a programmer, would be in the 1%. A director would be in the 0.25%. But again, those founding employees might get a couple times kicker on that because they've taken extra risk. Remember, you can always grant more shares. And so this is the spreadsheet. And what I would say is, just like I said, bring up your 4-year P&L and look at it, and then go to the detail and see whether you change the detail if you don't like what you see. Look at this. If you don't like, at the end of the day, if you're Jack and you say, I think that I should own more than twice as much as these employees, these other founders, the time to negotiate that is here. It's too late when you get out here. So putting together this model helps you see where the shares are going to go, what you're going to be left with when you think about how much money you're going to have to raise, what valuations you might be able to get, and the employees that you're going to have to join. So we got through everything. All I would say is my email's up here. Feel free to shoot me a question if you have a question about valuation or putting together the model. Both spreadsheets are available, as is the presentation. It's 8:59. Thank you very much.